Okay, so we're back, and we're going to talk about the cost of goods sold on account, and we're going to talk about and show different transactions for you. So the purchases account is used to record the cost of all merchandise bought for resale. Goods purchased for resale are one of the major costs of operating a merchandising business because costs, like expenses, decrease your net income and ultimately decrease the owner's equity. Purchases is debited when merchandise is purchased. So this is our rule here. Okay, so cash purchase of merchandise. Purchase sports equipment from Schwinn, $500 using check 86. For this transaction, Pan Canadian Sports Equipment has issued a check. The two accounts involved are cash and purchases. So your cash has to be credited and you will debit your purchase account. And your T accounts would look like this. Credit purchase of merchandise. So you purchase tennis equipment from Spalding, $200 on account with net 30. So your accounts payable, Spalding, would be a credit of 200. And it's important that you put who you have to pay it to. And your purchases will be a debit of 200. And it'll look like this. As indicated earlier in the text, costs or expenses are recorded when incurred, not when paid. Therefore, cash and credit purchases are both recorded in the purchases accounts to obtain the correct balance for merchandise purchases. If the merchandise purchased from suppliers is unsuitable for resale, it is returned. The accounting entries and procedures for purchases returned are similar to those for sales returns. When the purchaser returns merchandise, a cash refund is given for items previously paid for, and credit is given for unpaid invoice items. The purchases, returns, and allowances account is the account that you're going to use. So returned merchandise worth $100 purchased for cash, received refund check for $100 from Schwinn. So your cash is going up with $100, and you need to put that into your purchase, return, and allowances credit of $100. And your T accounts would look like this. Returned defective tennis equipment purchased for $200 on account this time, received a credit invoice. So now your accounts payable has to go down $200 and your purchase account will go up by $200. And now your T accounts would look like this. As mentioned earlier, the source document that is completed when goods are returned is the credit invoice. And purchase discounts. Just as Pan Canadian Sports Equipment offers discounts to its customers for early payment of bills, it also receives discounts for the same reason from its creditors. So received an invoice for $500 from Spalding, terms $215, net $30. So Pan Canadian Sports Equipment checked the invoice for accuracy, and since the merchandise was received in good condition, the invoice was approved for payment. Pan Canadian Sports Equipment's account that record the invoice appeared in the following T account form. So the purchase, debit of $500, accounts payable, credit $500. Okay, now we want to record the purchase discount. When invoice 4918 was received, it was placed in a file dated June 25th. Then on June 25th, when the payment for $490 was due to Spalding, it was recorded in Pan Canadian Sports Equipment's accounts as following. Okay, so you'll see here we want to pay off. We want to make that a zero balance. We won't owe them anything else after this. But we are only paying cash $490. The other $10 was going to go towards a purchase discount. And this is what your two accounts or your two general entries would look like. The cost of merchandise purchased for resale is increased by the cost of transporting the merchandise to the retailer's place of business. Transportation in or transportation on purchases is the account used to record this cost. Okay, so if you look here, and you're going to add that to the purchase cost. Received an invoice for $55 from CN Express for transportation of merchandise purchased, net $30. So you are going to pay them credit. sorry, with a credit, and it goes to accounts payable CN, and that account that it goes to is your transportation. And your T accounts look like this. You also have delivery expenses. The cost of delivering merchandise to customers is recorded in the delivery expense account. So you paid $75 to a local cartage firm for delivering merchandise sold to customers. So your cash is going to go down and your expense is going to go up. And your T accounts would look like this. Okay, and then if you were to look at your income statement now, you have your revenue section, you have your cost of goods sold section, and you have your operating expense section there. So that you can go back and you can refer to that. Every income statement is going to look the same. It's just going to have different numbers in there. So that's a good one to go back to and look at. Okay, I think you're okay with this so far. If we were to put everything together with the owner's equity being the umbrella and everything else kind of being underneath it, we know that anything on this side is going to increase our owner's equity and everything here is going to decrease it. And then these X's here show that everything here has a normal debit balance. And over here, everything has a credit balance. So that's another good one to go back and refer to. Okay, then just one last thing before I finish here. In this unit, you learned about the accounting system for firms that use the periodic inventory method. In this type of business, the owner does not need timely and detailed inventory. The periodic inventory method requires that the purchase of merchandise be recorded as a debit in the purchase accounts. The value of the merchandise inventory account be updated periodically after taking a physical inventory, and the cost of goods sold be calculated when the information is required. Okay, I think we can skip that. So I think this is the important part here is I'm going to show you some journal entries, and the left side is going to be how it would be recorded in the periodic inventory, and the right side will be the perpetual. So purchase sports equipment from Schwinn, $500 with check 86. So this would go to your purchases and your cash. With a perpetual inventory, it would go to merchandising inventory and your cash. Transaction 2, purchase tennis equipment from Spalding, 200 on account. The periodic would use the purchases and the accounts payable, whereas the perpetual one would use the merchandising and the accounts payable. So just different accounts, that's all. Transaction 3, received refund check for 100 would be your cash and your purchase returns and allowance. With the perpetual one would be cash and your merchandising inventory. Transaction 4, received credit invoice 981 for 200 from Spalding for returned tennis equipment. Your accounts payable and your purchase returns and allowance. And here, still your accounts payable, but your merchandising inventory. And received invoice 500 for Spalding. So same thing, you're using your purchases, your accounts payable, your merchandising, and your accounts payable. And same thing here, sent the check 490 to Spalding, so your accounts payable will be zeroed out. You're only paying 490 cash, the other 10 go to purchases discount. Whereas here, you're still zeroing out your accounts payable, your cash is being credited, and then you're going to be using your merchandising inventory account instead of your purchases discount. Okay, so I think sale of merchandise. So you sold merchandising costing $750 for 1,000. Your cash would go up 1,000. Your sales would go up 1,000. And with the perpetual one, you would have to separate it like this. Okay, so that's another good one to go back and have a look at as well. Transaction 8, credit sale offering sales discounts. So have a look at those two as well. And there's another example of your sale return on credit. And here you're recording a sale discount. Sometimes you have inventory shortages where you count it up, you do an inventory and it doesn't match. So you're going to use something called an inventory shortage. So it would look like this. This might be a form that you would use to actually take your stock, go and look to see exactly what you have and how many you have of each and what the cost of each one is. So that finishes that. So I went through it kind of fast, but you've got at least something to go back to and refer to, and it'll come a lot easier as we continue.